Okay. I think I've resumed the recording. Okay, thank you very much once again.
It's recording now.
Okay. Okay, thank you very much. As I've said earlier, welcome to the continuation of our classes on income taxes. And today we'll look at first, before we look at the assignment or tax we gave ourselves, we need to more or less do a recap. And I want one or two persons to just give us a summary of what we've done. And between Sunday and today, what new thing have you observed, or what are the new challenges you faced, so that we could be able to take it up from there. If you are willing to contribute, you can unmute yourself and let us move on. Who will talk? Hello?
Okay, so if I understand you, you want someone to give a summary of what we did over the weekend, yes?
Yes, summary of what we did and what have you more or less reconsidered, or what have you checked, or what new thing have you discovered, or what further understanding have you gotten between Sunday and now?
Okay, so over the weekend, we were basically reviewing our knowledge of income taxes and its computation. Basically, how to compute income taxes, the current tax portion and the deferred tax portion, as well as how to, well, that's the summary of what we did. And then we attempted questions to solidify the knowledge. So for me, there was nothing out of the ordinary that struck me while doing the assignment, except for the effective interest rates portion and a question that I wanted to ask regarding the Fed taxes, if it's accumulating over time, because we are doing for a 4-year period and we are supposed to prepare for each year. So I just wanted to know if the balance for each year would be transferred to the next year and then continue like that, or we just prepare separate for the separate years. Aside from that, no other questions from me.
Okay, thank you very much. Is there any other contributor? Any other contributor? Okay, in the absence of none, I think we could start the class. Okay, let's go back to the assignment.
Sorry, I don't understand.
Let's go back to the assignment. Okay, let me share the assignment once again. Okay. Now the assignment reads thus. Eva PLC starts a business on 1st of January 2014 with an initial capital of 1 million naira invested in the acquisition of plants for its operations. The activities of the company in the early stage are minimal, of which accounting profit for the relevant years, 2014 to 2017, are fairly stable at the sum of 400,000 naira per year. The accounting profit was after all operational costs, including depreciation, has been charged. The company depreciation policy requires a straight line basis of cost allocation. The Inland Revenue Service requires the cost of the plant to qualify for capital allowances, that is, tax depreciation, of 50%, 30%, and 20% on cost for year 1, year 2, and year 3 respectively. The corporate tax rate is 40% and has remained unchanged. Required, we are to determine the following: current taxes for the relevant periods, deferred taxes for the relevant periods, income tax expense or credit for the relevant period, effective tax rate for the relevant period. Now, in doing this, we need to first of all try to understand what the question demands. Now, the story behind it is that we had a business that just commenced in that year, 2014. And this company started up with a capital of 1 million naira via acquisition of a plant. And a plant is a qualifying capital expenditure for tax purposes. And this plant cost 1 million naira, in which that cost is admissible and accepted for tax purposes. Invariably, the capital allowance is to be claimed over a period of 3 years for these assets. 50% on the cost for year 1, 30% on the cost for year 2, and 20% on the cost for year 3. Whereas, for accounting purposes, the depreciation stands at the method adopted for depreciation was straight line method. And this asset useful life, based on available information, is 4 years, which means capital allowance will be claimed only for 3 years, while depreciation will be charged for 4 years. Therefore, this alone will create a timing difference of the recovery of the assets. Likewise, the basis for depreciation is straight line, which means equal amount of depreciation, whereas for capital allowance, it's more or less like a reducing balance, 50% in year 1, 30 in year 2, and 20 in year 3. Okay. With respect to that, we are also told that the company has fairly operated such that the profits for each of the 4 years seems to be equal. And on average, it stood at 400,000 naira. Okay, and also we are told that tax rate was 40% at the start of the business. And for a period of 4 years up to date, the tax rate has remained at 40%. Therefore, to attempt to solving the question, we'll start with the first aspect, which is what is our current tax for the relevant period? Okay, to do that, question 12. A, current taxes for 2014 to 2017. (2014, 2015, 2016, and 2017. Now, all figures in thousands. Okay, I think I didn't share that screen. Let me share the screen for this. Sorry. Okay, I believe I've shared the screen. Can you all see it?
Yes.
Okay, thank you very much. Now, in determining the current tax, we start with accounting profits. What's the accounting profit for year 1? 400. Year 2, we are also told is 400. Year 3, 400, and year 4 is 400. Now, remember that we need to carry out tax adjustments. And the relevant tax adjustment in this case is for us to add back depreciation. Therefore, accounting depreciation. Now, let's have a small working note. I have a small working note. Note 1, depreciation. Computation of depreciation and capital allowance. I can combine the two together. Depreciation is from financial reporting. Capital allowance is from tax. Okay. Now, we start with year 1, 2014, which is year 1. What is the cost? For financial reporting and tax, the cost remain 1 million. Depreciation is charged on a straight line basis, which is the cost minus scrap value over the useful life. In this question, we are not given the scrap value. It means the disposable value is 0, which then means that it is 1 million minus 0 over 4 years, which means our depreciation charge is 250. Whereas our capital allowance for year 1 is said to be 50% on cost. 50% of 1 million is how much? 500. Invariably, our carrying amount will be 750 as at end of 2014, while our tax base will be 500. Okay, I'll quickly do that for the other years so that I can more or less feel the result or output into other aspects of the solution. Now, I repeat the same thing for 2015. My depreciation, since it's straight line, it remains the same as 250. Whereas my capital allowance for year 2 is 30% of 1 million, which is 300. At the end of the day, my carrying amount is 500, while my tax base is 200. In 2016, my depreciation still remained at 250, given that it's a straight line, but my capital allowance is 20% according to the question of 1 million. That gives me 200. Invariably, my carrying amount is 250, while my tax base is nil. Let me put it 0. It's 0, nil. Now, in the last year, the asset is now fully depreciated with the 250, which shows my carrying amount is equally 0. Now, there's no capital allowance in year 3. Why? Because it has been fully, the capital allowance has been fully enjoyed over a period of 3 years, which means this is our position. Now, what do I need? I need information about depreciation for each of the years that have to be added back. And from this solution, I found out that is 250. I have to add back, which means each year, depreciation is 250. If a separate method has been adopted for depreciation, this value will vary. It won't be 250 across board. But because it's a straight line depreciation, the value remains the same. Now, what is my adjusted profit? My adjusted profit is 650 across board on the premise that my accounting profit remains the same over a period of 4 years. Now, what do we do? Since there's no loss to be relieved, the only thing to be deducted is capital allowance. I remember we've used a stone to kill 2 birds by computing our capital allowance alongside depreciation. And if you remember, what are the capital allowance? Year 1,
500.
was 500. Year 2, 300. And year 3, what? 200.
200.
Therefore, we replicate that up here. And I come here to say my capital allowance is 500 in year 1, 300 in year 2, and what? 200 in year 3. And final year, nothing. In that case, I obtain my taxable profits. What's my taxable profit? 150, 350, 450, and what? 650. What is our tax rate?
40%.
Our tax rate is what? 40%, and it has not changed over a period of 4 years. Invariably, what is our current tax? What's our current tax? What's our current tax? 40%, which means can somebody mute there? I hope this. hope I'm able to recover it. Okay, I think we lost that document. I think I didn't save it. I think we lost that document. I didn't save it. Okay. Okay, I think we just need to, let me quickly rewrite them and establish the situation. Let me put auto save on. Okay, sorry, we lost that document. It was not saved. I think I'll just try and write it. I'll try and write it, and this will give those that are just joining the opportunity. Okay, I think we started from the perspective of question 12. Now, since we have memory of some of those information, we can easily replicate them. Okay, today's date is 25th August 2020. Now we are told to compute the current taxes for 2014 to 2017. (2014, 2015, 2016, and 2017). Remember, all figures in thousands. Now, we said in computing our current taxes, we start with our accounting profits. And the question says our accounting profit has been fairly stable at an average sum of 400,000 naira. Now, we need to carry out tax adjustments. But of all of the adjustment required, the only one we have information about is adding back depreciation. And remember, we did a little analysis here, which we are going to repeat. And the analysis is note 1. We want to determine the carrying amount, CA, and the tax base, TB. And from financial reporting, we'll get, and from tax, we'll get our tax base. As against all value in thousands. Now we said year 1 is 2014, where we purchase the asset for 1 million, and that 1 million is equally accepted for tax purposes. Now, depreciation is on a straight line, which is the cost minus the scrap value divided by the useful life. And I've said here that in the question, the cost is given to be 1 million, but the scrap value was not given, which means the disposable value is 0, and the useful life is 4 years. That is what gave us 250,000 as the depreciation we charge. And likewise, capital allowance based on information provided, we are told is 30% on cost, and the cost is how much? 1 million. That's how we obtain 300,000. Invariably, we have 750 as the carrying amount, and we have 500
I
as the
think
tax.
capital allowance was 50% the first year.
Okay, yeah, first year, 50%, thank you. 50%, that is 500. 50% in the first year. That's 500. Okay, thank you very much. In the second year, the depreciation will remain the same because it's a straight line method. While capital allowance, we are told, is 30% in the second year. And that gives us what? 300. Invariably, my tax base is 200. My carrying amount is 500. Now, in the third year, my depreciation still remains the same, 250, but my capital allowance is 20% of 1 million, and that gives me 200. At the end of the day, my carrying amount and tax base, my carrying amount is 250, my tax base is nil. For the final year, 2017, my depreciation is 250. Remember, capital allowance has been fully enjoyed, which means there's nothing to be enjoyed again. Invariably, I have a 0 at the end of 4 years for both. Now, this information is what we adopt Depreciation remains the same for each of the years. 250, which we are adding back, 250. And that gives me 650 across board. And we're having this because, one, we are told that the profits for the first 4 years are fairly stable on an average of 400,000. And second, depreciation was straight line, which means you should not expect it to be the same in all instances. Now, there's no tax to be relieved. Therefore, the only deduction available is capital allowance. And based on our computation, for the first year is 500, second year is 300, third year is 200, and last year is nil. Therefore, we obtain our taxable profits, which is 150 in year 1, 350 in year 2, 450 in year 3, and 650 in year 4. Next, we obtain our tax rate. What is our tax rate? It's 40%. And this 40% remain constant over the 4-year period. Invariably, my current taxes will be Roman figure 1 times Roman figure 2. What does that mean? My tax rate multiplied by my taxable profits will give me my current taxes. Can we bring out our calculator and let us determine that? 150 times 40%, what do we have? What do we have? 60. 40% of 350?
140.
140. And 40% of 450?
180.
180.
And 40% of 650?
260.
260. Thank you very much. Now that answers the first question, which means current tax is based on the computation from the tax law, which says your accounting profit is adjusted for items such as items not allowable for tax purposes, income not taxable, income taxable but omitted, expenses allowable but omitted. But of all of those adjustments, the only one we have available here is depreciation, which is disallowable expenses. And upon that, we obtain our adjusted profits. And thereafter, depreciation was deemed to be disallowed because it's being replaced by deduction of capital allowance. And that's how we're able to obtain our taxable profits. And your tax rate ruling as at that date multiplied by your taxable profit for that year will give you your current taxes. I believe this is so clear. Is it clear?
Yes, sir.
Okay.
Yes, sir.
Okay, thank you very much. Now let's now attempt the second question. The second question says, defer tax for the relevant period. That is the B aspect of the question. We label this A. This is A part of the question. Let's go to the B. Now we are at the B part of the question. The B says defer tax. Now, if you remember, if we are to compute deferred tax, we are computing deferred tax for each year. How many years do we have? 2014, 2015, 2016, and 2017. What do we need? Deferred tax is computed on assets and liabilities. But in this case, we only have an asset, be it a plant. And to determine deferred tax, we need to observe whether there's a temporary difference. And to know whether there's a temporary difference is for us to compare two things. What are the two things we compare to determine temporary difference? What are the two things we compare to determine temporary difference? Can anybody answer?
Carrying amount and tax base.
Which means I need the carrying amount and I need the tax what?
Base.
But can you recall that in our notes or workings, we are able to obtain carrying amount and tax base. And for our memories, we can see that in year one, the carrying amount was 750, whereas the tax base was 500. In year two, the carrying amount was 500. The tax base was 200. In year three, the carrying amount was 250. The tax base was nil. And in year four, both tax base and carrying amount became 0. In that case, I'll use that to populate that schedule. Now, all figures in thousands. 2014, we have 750 and 500. 2015, we have 500 and 200. 2016, we had 250 and 0. And 2017, 0, 0. Do you all agree? Therefore, what is our temporary difference? Temporary difference is the difference between the carrying amount and the tax base. For year one is 250. For year two is 300. For year three is 250. And for year four is 0. Now the question then is, this temporary difference, is it taxable or deductible? Who will answer?
Taxable.
Taxable.
Is it taxable or deductible?
Taxable.
Okay, let me quickly take
It's
us
a
through.
deductible taxable difference.
Let us go back to our deferred tax matrix.
Taxable.
Let us check our deferred tax matrix again. We are comparing, we are looking at assets and we are looking at what? Liability. Is that not? We are looking at a situation where the carrying amount is greater than the tax base or where the carrying amount is less than the tax base. Now, if you remember, we said by convention, where the carrying amount of an asset is greater than its tax base, what do we have? Taxable. Is that not? When it's liability, we have what? Deductible. Likewise, deductible and what? Taxable. Now, look at the situation we find ourselves. In this case, in this situation, we are dealing with what? An asset, because plant is an asset. 2, we are dealing with a situation where in all of these years, the carrying amount of the plant is higher than the tax base, which means we find ourselves in this situation. Now, what is a pivot cell here that recognizes the fact that the carrying amount of an asset is greater than the tax base? What is the result we have? Is what? Taxable. Which that means in this case, is simply put that this temporary difference is what? Is taxable. Is what? Is taxable. Therefore, what is our tax rate?
40%.
Our tax rate is 40% over a 4-year period. And remember that when you multiply tax rates by a taxable temporary difference, what do you get?
Deferred tax.
You get what? Deferred tax, asset or
liability.
liability. Thank you very much. Which means in this case, my deferred tax liability, can we move our, hello? Okay, which then means that my deferred tax liability for each of the year as at the reporting date is 40% of 250 should give me 100 for year 1, 120 for year 2, 100 for year 3, and what is 0 for year 4, which means our deferred tax liability as at end of 2014 is 100,000 naira. End of 2015 is 120,000 naira. End of 2016 is 100,000 naira. And end of 2017 is 0. And I'm going to explain what it is. I will explain what it is. Okay, the year. Let me put it here because it's not clear at the other side. This 14, 15, 16, and 17. Okay, now this first 100, is what I would consider the originating timing difference, because that was when the difference first occurred. And within this period, to this period, the difference is reverse itself, which means we call it reversing timing difference. And why do we call it so? Remember, we said deferred tax emanates from temporary difference. And we said it is temporary because the difference that seems to exist will reverse itself so that no difference will exist at the end of the day, which means the difference is just for a while. It's just for a certain period of time. Over the period, the difference will zero-rise. And that's why we call it a temporary difference. And this temporary difference is as a result of the timing of recognition of an item between when financial reporting principle requires a recognition and when tax laws or requirements requires that recognition. You find out that the same cost of asset of 1 million was required to be inflated over 4 years on a straight line basis, whereas the same 1 million is recognized to be allocated by way of capital allowance for 3 years. But at the end of the day, you both enjoy 1 million for deduction for tax purposes and still enjoy it the similar way, but in different period for accounting purposes of that same 1 million, which means invariably at the end of the day, there is no difference. Only that because as at the time we are looking at it in year 1, it seems that there is a difference. In year 2, it seems that there is a difference. In year 3, it seems that there is a difference. But by the time we get to the end of year 4, the difference no longer exists, or because it's a timing factor. And that's what we are talking about. And later on, we find out that deferred tax itself is not a tax. It's not what is payable. What is actually payable still remains your actual tax. But what is the role deferred tax tend to play? As we move on, you are going to see clearly the role it tends to play. Okay, in this case now, we've determined our deferred tax liability. But the question as asked is talking of deferred tax for financial, income statement, which means what is a deferred tax that we are going to report as an expense or as a credit in our income statement. In that situation, what do? We need to look for the movement in our deferred tax liability. We need the movement in our deferred tax liability, which means for me to determine my deferred tax expense, I need to look for the movement in deferred tax liability. I have 4 years here, 2014, 2015, 2016, and 2017. Remember, all figures are in thousands. Okay, what do we do? Deferred tax liability brought forward. I'll compare it with my deferred tax liability carried forward. Remember, brought forward means deferred tax liability as at the beginning of the year. Carry forward means deferred tax liability as at the end of the year. Now, invariably, what is my deferred tax liability as at the beginning of 2014? Who can assist me in this case? What is?
Zero.
Is what?
Zero.
Is zero? Are you sure?
Yes.
Yes.
Are you sure?
2014. Beginning of 2014 is zero.
Is zero. Why is it zero?
There's no opening balance for. There's no opening balance of deferred tax liability.
250.
There is no opening balance, or we are not given.
250.
Or
We are
what
not
is it?
given.
We are not given.
We are not given.
Okay. Okay. Is that correct? Are we given or not? Check the question well. Are we given or not? Let me switch to the question.
No, since the asset was just purchased in 2014.
Are you sure? Look at the question well. Even though the answer is zero, but the reason why
it just started
zero,
business in 2014.
exactly.
It just started business in 2014.
Yes. A company that just start up in a year cannot have opening balance of anything.
Anything, yeah, that's correct.
Every balance at the end of that year as a result of activity introduced in that year. Nothing like opening. Because a new company that is set up starts from ground zero. You need to understand that. Which then means that in the examination question, if this 2014 is not the first year of the company, there is a probability that it might have balance of deferred tax liability carried forward from 2013. We need to understand that so that we don't assume it's zero without understanding why it is zero. Thank you very much for that. Okay, we go back to our board. Now, deferred tax liability brought forward in year 2014 is zero because that was our starting year. But as at the end of 2014, it stood at 100. Can you remember?
Yes.
We can remember. Okay, let me Let me try and switch it up so that you can see it from what we did up here. Can you see it? It was 100.
Yes.
Okay. Now, let us check. Is this an increase or decrease? It was a zero liability at the beginning of 2014, but now it is 100. Is it an increase in liability or decrease between the beginning and the end?
Increase.
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 Okay. Increase of how much?
100.
100. Now, increase in liability will be considered what? An expense or an income? From your conceptual framework. Remember, what's the definition of an expense?
An
An
expense.
expense is
Expense.
a decrease in equity, which is attributable to a decrease in an asset or an increase in liability other than distribution to equity participants. Okay. Also, we are all aware that your balance carried forward in 2014 is what is brought forward to 2015. True or yes?
Yes.
True.
Okay.
True.
Which then means that that is our opening balance in 2015. What was our closing balance in 2015 from our deferred tax computation here? Is that much? 120.
120.
Okay, I come here and say this is 120. Now, for this year, is it an increase or decrease?
Increase.
Another increase of what? 20. Which means we recorded another expense for that year. Now, also, as I've said earlier, our balance in 2015 is carried forward 20, which is what?
I'm in a
120.
meeting now.
Now, what is our balance as at end of 2016?
100.
100. Let me show us again. 100. Okay. I'll come here and say this is what? 100. Now, this, is it an increase in liability or a decrease in liability?
Decrease.
Decrease.
Of how much?
20.
20. Okay. Which is what?
Assets.
Liability.
A credit.
It's
Income.
credit now. It's an asset.
Income.
An asset.
Abi? Okay. A decrease in liability is attributable to income, Abi, given that you didn't settle the liability. Okay. And also, finally, the balance in 2016 is brought forward to 2017. And we close out with what? Is 0 in 2017. Therefore, invariably, what do we have? We have a decrease of what? 100. Okay. Now, I'm using the color to show that one is positive, one is what? Negative. And I can also make it clear for us that let me put it in jacket so that we can be clear. Okay. And this is credit. Now, in that case, our deferred tax
You don't know what they are
expense
seeing now.
for
It's for
2014 is 100.
Mute
2015
your radio.
is 20.
Wait.
2016, we have credit of 20. And 2017, we have credit of 100. Now, what is the third question?
Cyril, mute your system or your whatever you're using.
Device is ready to pair. The Bluetooth device.
Can we all mute our system, please? You are only allowed to unmute when you need to contribute. Thank you very much. Okay. Now, the question says, income tax. That's our C question says income tax expense for relevant period. Therefore, that's our C. Okay, I shoot back. I shoot back. Remember that is B. Therefore, my C. My C says, what is our income taxes? Tax expense for 2014 to 2017. Now, what's my current tax? My current tax from above, if you remember, is what? 60, 140, 180, and 260. Can you see it?
Yes.
Okay. Now, I come here to write 60, 140, is that correct? What's the next one?
180.
180 and what? 260. Okay, thank you. Now, what is my deferred tax? I had expense of what? 100. I have 20. And later on, I had credit of what? 20 and what? Credit of 100. Remember, credit or income is offsetting an expense, which means it's reducing an expense. That's why it's negative. Invariably, what is my income tax expense for each of those years?
160.
Year 1 is 160, year 2 is 160, year 3 is 160, and year 4 is 160. Now, what are we trying to achieve? What we are trying to achieve is that if you recall, our accounting profits on the average for 2014 to 2017 was how much? 400,000 per year. Is that not? Now, yes. And also if you recall, our tax rates between 2014 and 2017 was 40% and it remained unchanged. Which means if you go by way of this estimation of tax, our estimated tax should be 40% of 400,000 naira, which will give us how much? 160. This 160 is the same 160 we are seeing here. Now, what deferred tax is saying is that if you recall, from the tax law, we are told to pay 60 in year 1, 140 in year 2, 180 in year 3, and 260 in year 4. When you sum everything together, how much are you required to have paid as current tax over a 4-year period? Can we sum it together? Can we sum it together?
640.
640.
640.
640. Now, let's now also sum together the deferred tax for the 3 years. What do we get?
Zero.
0. Okay?
0.
Now let's now sum all together the income tax that we are recognizing. Sum 160 in 4 places. What do you have? 640. Now you find out that it's a matter of time that deferred tax is not a tax. Deferred tax is not what? A tax. What deferred tax only try to do is that in the year the tax law says pay 60, we recognize the fact that though the law says we should pay 60, but in real sense, what tax that is due based on our performance should be 160. Therefore, even though we comply with the law by filing 60, we immediately come back to make provision for additional 100, so that in our income statement, I will not recognize 60. I will recognize 60 by law and 100 by accrual to make up what? 160. Are you getting it now? So that in year 2, even when my profit remains the same, the law is now changing mouth to say I should pay 140 on the same level of profit, and the tax rate has not changed. But that 140 is higher than 60 because the law is now recovering back its money. And in that case, I'm supposed to recognize 160, but the law says pay 140. What then will I do? I'll pay 140, but still come back home to recognize that 20 I'm still owing, because the government will still come back at a later date to demand for it. Therefore, I also make another provision of what? 20. Which means cumulative provision I've made in 2 years is now what? 120. In year 3, the law is now saying pay 180, whereas what I ought to pay is 160. But I recognize that the law is telling me to pay 180 now, because out of those relief it gave to me earlier, I'm now to pay back. Therefore, what will I do? I'll go back to the provision I made of 120. What will I do? I'll take 20 out of it, Abi, and use it to reduce the amount of tax, even though I'll pay government 180. But I will go back to provision to release 20 out of it because I've already provided for it and it has now crystallized. Therefore, what do? I release the provision. And that's how I release this 20. So that the impact of the tax will be 160 in my account, even though I paid 180. By the time I got to the last year, which is 2017, the law is now arbitrarily telling me to pay 260. But I know that my tax impact should be 160. But what did I observe? I observed that ab initio, there was 120 I provided for, of which last year I released 20. Now, releasing 20 from 120 leave me with what? With 100. Now, that 100 is what I'm now finally releasing, so that 260 now comes back to what? 160. Which means deferred tax is just an accounting measure. It's a form of estimate made from accrual as an adjustment to your current tax, so that your income tax is a reflection of the impact of a tax on your performance. And that's what we are just trying to do. Which means deferred tax itself is not a tax. Deferred tax itself is not what? A tax. But what is deferred tax now? In summary, you find out that deferred tax attributes of deferred tax is that 1, it is not a tax. But what is it? It is rather an accounting measure. And why do we need this measure? It's an accounting measure which is for adjustment, as an adjustment to what? To current taxes. That's why we said the adjustment can be positive or what? Negative. And why are we making adjustment to current taxes? Is because we want to reflect or capture the future tax consequences of current period transactions, events, and activities. And that's not what we are trying to do, which means in real sense, deferred tax will not result into a payment of tax. It's just an accrual that tends to provide for the gap between the tax impact on performance and what the law requires you to pay. And at every point in time, you must comply with the law first. The law says I should pay 60 in year one, even though from my performance in year one and applying the tax rate, it should be 160. What will I do? I reserve 100 immediately, provide for it so that I don't eat it along with my profit distributed. In year two, it says I should pay 140, whereas it's supposed to be 160. I reserve another 20. In year three, it told me to pay 180, even though I know that it's supposed to be 160, but I call that, okay, he's not calling back for his excess fund that I've reserved. I release 20 to him. And in final year, it required 260, which means he's calling back for all of the excesses that I've reserved for it, and which I have to release. And that is why, if you go back to this drawing I made, I said it's like when you have a road. I'm coming. It's like when you have a road. Remember I said we have a road that is not smooth. This is the road. I said, what do we do to a road like this? Is for us to grade it. How do we grade it? Is for us to find a tractor that will tend to smoothen the effect of the road. At the end of the day, what do we do? Is that where we have excesses, we cut it off and we use it to fill the valleys. Where we have the hips here or the edges here, we cut it off to fill the valley. At the end of the day, we are not bringing in new sand or anything or gravel. But what we are doing is that we are taking from the same excess to fill the holes. And at the end of the day, what do we have? We now have something motorable in this manner. This is what we have tried to do. And that is the effect of deferred tax. Deferred tax is to smoothen the profits by adjusting for the effect of taxes to reflect tax impact on the performance of an entity from financial reporting perspective. And this is one of the principles that we harness with respect to substance overflow, which means economic substance and financial reality of transaction take preeminence in accounting over the legal form or legal requirements. And that's what we have done. Now, I can also show you here by way of a chart. Let me draw like a graph for this, just to further buttress our points. Let me try, if this is a straight line, you pardon me. Now, this is the axis for value. All figure in thousands is 50, 100, 150, 200, 250, 300, 350, 400, and 450. Now I have 2014, 2015, 2016, and 2017. These are the years. Okay, now profit for each of those years were said to be 400. Which means if I draw the line, I'll be drawing something straight line, assuming this is a straight line. I'll call this my income tax curve or line. Now, let me plot my current tax side by side. My current tax in first year is 60, somewhere here. In 2015, it is it 140? Somewhere here. 180, somewhere here, and 260, somewhere here. You can see that my tax is upward sloping. That is my current tax curve. Now, what is my income tax curve? My income tax says each of the year is the same at how much? 160. Therefore, 160 lies here. And this also forms like a straight line. Don't mind my line. Therefore, I'll call this income tax line. Sorry, this income tax line. The first one is not income tax line. This is profit line. This profit line. This profit line. Now, what is the gap? The gap here represents the gap initially created by originating difference, which you have to provide for by way of deferred tax, and which will be used to fill in the gap here when government start to call for it. Which means in these first 2 years, government is like giving you relief to say, okay, be paying lower than what you are supposed to pay, with the hope that when tomorrow you have settled, they start to demand more than what you're supposed to pay. You now use those savings to offset those excesses at a later date. And that's what we are trying to explain with respect to deferred tax. And this is just a simple way of computing deferred tax, which also more or less brings us back to our memory to say that the first thing you need to do in deferred tax is to look for the carrying amount and the tax base of the asset and the liability that are concerned. Look for where there are differences between the carrying amount and the tax base. Where there are differences, identify whether it is taxable or it is deductible. And when you have identified that, you apply the relevant tax rates. When you apply a tax rate, it gives you deferred tax liability if you apply it on a taxable temporary difference. But it gives you deferred tax assets if you apply it on a deductible temporary difference. Is that okay? And that is the position we have here. Now, I'll show you a shortcut to something. This deferred tax expense and income we derive here, which you can see here, or what we derived here, you can equally summarize it in this table without going far. Which means this line I created here, I can easily adopt it. I can easily adopt it. I can easily adopt it and say, I want to determine my deferred tax expense or credit. Now, look at it. In the first year, I'm recognizing deferred tax of 100. I remember I'm coming from ground zero. Ground zero to 100 means that there's an increase of what? 100, which I recognize as an expense. Now, between year 1, 2014, and end of 2015, what has been the marginal change? The marginal change is an increase of 20, which shows another what? Expense. But between 2015 and 2016, the marginal change reduces, which shows that it is what? A credit. And between 2016 and 2017, the marginal change dropped from is 100 to what? Is 0, which is a credit. Which means instead of me, if I am in examination hall and I have no time available for me, I can easily summarize everything on this single schedule, which will show me the movement. It's just for you to look for movement, which is the same thing we did down here. And it's going to give you the same results. Okay, which means one thing is to acquire knowledge. The next thing is for you to be smart about the knowledge, because timing is also a factor in getting things done in an examination hall. Which means one thing is for you to know, one thing is for you to also be able to display that knowledge based on available time. And that is that. And that brings us to the solution to this question. Any question on what we've done so far today? Any question on what we have done so far today? Any question? Any question? If there's no question, can I continue? Okay. Now let's quickly look at this simple question. I'll give you 5 minutes to attempt it. It's a past question for November diet, the last examination by ICA. And I want us to solve it. I'm going to put this question on the screen. And you will solve it there. And I will solve my own. I will not share what I'm solving, so that at the end of the day, we'll both show our answers. I'm sharing the new screen. Now, this is a question. Okay. The first question, I'll not require you to answer that because we've discussed it and you can answer it at your own leisure hours. We talked about you explaining the different components of income tax, current and deferred tax. But what I want you to attempt is this second one. Okay. Let me try and reduce it so that I can fit one page. Okay, can we all see the question? Okay, we have just 10 minutes to attempt this question.
Resume.
Okay. Let me share my solution. And I believe we should be on the same page. Okay. Question 3 of ICANN November 2019 diet. And I think the question goes for 20 marks in all. But the first 5 marks borders on your explanation of current and deferred tax, which I believe you end up 5 marks easily. But let's look at the B question. The first set of B is for 10 marks. It wants us to calculate the income tax and also want us to determine the deferred tax liability. Okay, but we all recall that income tax comprises of current taxes and deferred tax. Now let's compute our current tax first. From what we can see, our accounting profit was 121,000. Okay, and remember, we have to add back depreciation, and the information was made available to us. And that gave us our adjusted profit of 132. We deducted capital allowance of 15,000 as provided to us, and we have our taxable profit of 117,000. Given that the tax rate is 30%, we're able to arrive at 35,100. Very simple. The same, similar to what we have solved as we started the class, I think last week, that's on Sunday, and also today. Now, for deferred tax, what do we need? We needed the kind amount of the PPE, and luckily for us, in the balance sheet provided, is clearly shown as 49,000. And our tax base is simply the difference between the cost, which is 60 million. By the time you add the 2 categories of assets, the PPE and the motor vehicle, everything comes to 60. And by the time we deduct 50 million, which is the capital allowance granted so far, it gives us a tax base of 45. It then shows us that we have kind amount of 49 and tax base of 45, giving us taxable temporary difference of 4 million. It is taxable because we are computing deferred tax for an asset that has this kind amount higher than the tax base. And applying the tax rate of 30%, it gives us a deferred tax liability of 1.2 million. Again, to determine deferred tax expense or credit, we need to compare the deferred tax liability at the end of the year with the beginning of the year. And this question is also similar in all respect to the one we saw before, which says, it says the company was incorporated on January 1st, 2018. And that is what gave rise to we recognizing this 0. What that means that the movement is the entire 1.2, which created an increase in liability, which gave us the position of an expense. Now, the question has still not been answered. The question says, what is our income tax? What is my income tax expense? It is my current tax expense of 35.1 million and deferred tax expense of 1.2 million. The two sum up to 36.3 million. Second question says, we should redraft the income statement showing an extract of the impact of that tax on the account. And what is the impact? We'll go back to show our revenue. We have our admin expenses, and our profit before tax and depreciation was 132. We'll go back to deduct depreciation. We have our profit before tax to 121. And by the time we deduct our income tax, which is made up of current and deferred tax to the tune of 36.3 million, we arrive at our profit for the year of 84.7 million naira. And that is for you to earn 20 marks. Very straightforward, very simple question. From your own side, Did you get the same thing? Hello?
Yes, sir.
Did you get the same thing?
I did, sir. Yes, sir.
Okay, who else?
I got the same thing. I got the same thing.
Yeah, thank you. That's very lovely. That's very lovely. That's very lovely. Now, because time is also against us today, we'll likely look at it tomorrow to continue. And what are we going to look at tomorrow? Let me just show you. I'm going to give you an assignment. Can you screenshot this? I'm going to share it with you now. I'm going to give you another assignment, but I'll tell you where it is. Also, it's November 2018. November 2018. I think it's question, let me check. November 2018. Let me share the screen. November 2018, question. Okay, question 3. Question 3. And I think I'm seeing one pattern here, but I don't know how true the pattern is. November 2019 is question 2. Why November 2018 is question 3? Probably it will be question 1 in 2020. Okay, I'm just joking. Okay, but this is a question. This is a question. The question presents you with the balance sheet of Yemenike Nigeria Limited, and also provided you with about 6 additional information. And the 20-mark question reads thus: A, calculate current tax expense for the period, 7 marks. Calculate deferred tax liability, 12 marks. And prepare notes showing the component of tax expense, 1 mark. Now, let me explain these questions to you. Now, remember, all of the questions we have computed, we are only computing deferred tax on one specific item, whether as an asset or a liability. We've done for plant, we've done for provision, for warranty, we've done for other class of asset, motor vehicle and co. But in this question, remember, deferred tax is computed on all assets and on all liabilities. Now, they've given you different classes of assets and liabilities in which you have to compute the deferred tax effect, which then means that you pick them one by one. Building, you compute deferred tax effect on it. Plant and machinery, you compute deferred tax effect on it. Assets under finance, asset held under finance, you compute deferred tax on it. Trade payable, trade receivable, all of those items in the balance sheet, other than capital, you compute deferred tax on them. And that's what you need to know, so that you don't just pick building or plant and machinery and say it's an asset. No, deferred tax is computed on all assets and liabilities. Okay, provided they result in a temporary difference. Now, what we are going to wrap up with tomorrow is this. Let's go back to our PowerPoint material. Okay, I think I've shared it with you. Now I've shared it on the screen. Okay, what we are going to look at tomorrow, we've looked at all this. Okay, tomorrow we are going to look at tax base. We'll look at tax base. What is the tax base of an asset and liabilities? Even though we have determined some tax bases, but those ones are easy to determine because they are on PPE. But what about if you want to determine tax base on inventory, on receivable, on payable, on accrual? How do you determine that? We are going to look at the definition of tax base for an asset and also for liabilities with some examples. We're also going to look at, okay, you know, I've explained to you on Sunday, differences between permanent difference and temporary difference. Okay, and also we are going to look at deferred tax arising on business combination, just introduction, because it's not necessarily in your syllabus. It's at corporate reporting level, which is final level, but you just need to have an idea about it. We also have to look at, we've looked at this before, the matrix that I showed you earlier. Okay, we've looked at this before. Okay, we'll also now look at the principle or the school of thought with respect to recognition of deferred tax provision. We have the new school of thought, we have the partial school of thought, and we have the full school of thought. Which position is the position of IAS 12? Vis-a-vis the role discounting plays in the computation of deferred tax. We'll also look at it tomorrow. Now, tomorrow, we'll likely look at the effect of changes in tax rate. Remember today, we said the tax rate remained unchanged over the 4-year period. What if there's a change along the line in the tax rate? What happens? We'll also likely look at that tomorrow. And looking at that tomorrow, I'm going to give you an assignment. I'm going to give you an assignment that is going to, more or less expose you to that understanding and knowledge. Okay, so that the outcome of your assignment, we'll solve it together and make corrections where necessary. Okay, the other one we are going to look at is, okay, we'll summarize this before. Okay, the steps again. I try to itemize the steps you guys have to look at in computing deferred tax, which is the same step that we have always been following. Okay, and summary of deferred tax computation, both at asset level and liability level. Okay, and that just brings us to the end for today. And tomorrow, God's willing, we'll likely start 8 o'clock on the dot. Any question before we move on? Any question before we move on? Any question before we move on? Okay. In the absence of no question, we'll call it a night. Thank you very much, and God bless you.